with module number 4, okay, under subject financial management. So students, module 4 is basically investment decisions, and it is divided into two parts. First part is capital budgeting, which is theory only. So whatever is given below capital budgeting, all this is only theory. And what you all can see on the right hand side, that is investment evaluation techniques. All these below is theory as well as problems for your final examination. So under capital budgeting, what we will be seeing is meaning of capital budgeting process, capital rationing, risk analysis in capital budgeting, and capital budgeting techniques. Now students, this capital budgeting techniques is nothing but investment evaluation techniques. The other name for capital budgeting techniques is investment evaluation techniques. And these all are nothing but techniques which are going to help us to evaluate a particular investment. So under that we have payback period, discounted payback period, accounting rate of return, net in present value, internal rate of return, modified internal rate of return, profitability index, and we have case study on replacement of capital project. So in short, what we have to study in this particular module is all the capital budgeting techniques, which is going to help us in finding out which is the best investment suitable for any particular business unit. Now, in today's lecture, we will be covering capital budgeting only theory portion. So what you all can see here is we will be covering everything on the left hand side. So today we will understand the complete theory on capital budgeting. So we are going to cover the left hand side portion. Let us understand what is the meaning of capital budgeting. Capital budgeting is the process a firm undertakes to evaluate potential major projects or investments. Capital budgeting is a process of evaluating investments and huge expenditures or expenses in order to obtain the best returns on investments. It is required in order to know whether a particular investment has to be approved or rejected. Now, in short, let me tell you students, every firm, let it be any firm, big, small, they always have to make certain investment decisions. So decisions would be generally maybe whether to expand the business or not, whether to acquire some other business or not. So investment decisions can be either expanding the business, it can be acquisition, it can be modernizing the business, it can be replacement of some long-term assets if you want to replace some assets. So at every stage a business unit has to make certain decisions regarding investments. Okay, now long-term assets are what students, as you already know, it are assets which are going to affect the firm's operation beyond a period of 1 year. If they affect the operations within 1 year, it is a current asset. But when we say long-term asset, it is going to affect the firm's operation beyond 1 year. Correct. So if a firm or business unit wants to decide whether it wants to replace this asset and purchase a new asset, whether it wants to expand or not, whether it wants to modernize its business or not, so obviously it has to make certain investment decisions. Now, these investment decisions, what a firm makes, is generally known as capital budgeting. Okay, students, or you can say capital expenditure decisions. Because see, whenever a company wants to make any investment, there is obviously an outflow of cash, means there is an expenditure. So in short, just remember students, whatever investment decisions a firm is taking, it is always termed as capital budgeting. So is this clear students, what is capital budgeting? So basically when a firm wants to invest, so what it will do is, it will see what are the different investment opportunities that are available to the firm. Okay, it will evaluate those opportunities and then it will select that best opportunity or that best proposal of investment which is going to give the firm the best returns, or you can say higher returns. And the other investment proposals which are not that beneficial to the firm, it can either reject it or it can consider it later. So in short, did you all understand what is the meaning of capital budgeting, students? Because many a times the organization is facing a lot of challenge in selecting which is going to be the most beneficial investment. If there are many investment plans in front of a company, it is very challenging for the company to select the most beneficial investment, and for that purpose capital budgeting process is to be done in order to select the best particular investment. Is the meaning of capital budgeting clear to everyone? Yes, students?
Yes, ma'am.
Okay. So what happens is usually the organization or the business unit, it wants to invest in the profitable projects, like whichever projects are going to give maximum profits. But many a times the firm is facing the problem of shortage of capital, or finance is not that very much that it can invest. So it has to choose such an investment. Okay, it has to choose such a project where it is fitting within the budget of the company, as well as it is going to give the maximum profits to the company after selecting that particular investment proposal. So this in short is meant by capital budgeting. Next, see here in this particular image, you all can see that this is a particular building, which a long-term asset you can say, and this person is thinking, should we pursue the building of this plant? So capital budgeting is nothing but thinking, deciding whether a particular investment, this is an investment. When you're investing in a building, it is an investment, correct? So whether to invest or not, whether this particular investment is going to give a series of expected flow of benefits over a period of time, or whether this investment is fitting within the budget of the company. So there are several things to be considered with before making an investment plan. So this is capital budgeting, where this person Peter is thinking whether he should invest in this plant or not. It is costing, the project cost is $10 million, so whether he should invest it or not. So this is capital budgeting, where you make an investment decision depending upon your budget, depending upon the expected projected profits it is going to give over a series of time. Okay, and depending upon whether it is going to be beneficial to the company or no. Now moving ahead, let us understand the capital budgeting process. So first of all is, whenever you want to evaluate whether a particular investment should be selected or no, you have to go through the capital budgeting process. So let us understand the process step by step. First thing the company has to do is identify different investment opportunities. So the first process of capital budgeting is to identifying investment opportunities. Now, what does this mean? This means that every organization should first, identify what are the different investment opportunities available. Okay, an investment opportunity can either be, as I already told, to form a new business line, or to introduce the new product into the business, or to expand its business, or to purchase a new asset. Okay, so what happens here is, it has to identify what is the investment opportunities available. For example, you can say that a company finds two new products, and it is planning to add to their product line. So if the company is already selling a particular product and it finds that two new products it can add to its product line, this is nothing but identifying investment opportunities. It can be anything, students, taking from expansion to acquisition to modernization to replacement to purchase of new asset to adding some product in the new product line. Next, evaluating that particular investment proposals. So Once the company has identified what are the investment opportunities available, it has to evaluate that particular investment proposal. So what happens in this is to say that once it is decided, like in my previous point I had told you, for example, suppose it is going to add 2 more products to their product line. So once it is decided that the new product should be added to the product line, the next step will be it has to decide how to acquire these products. Okay. So there will be multiple ways in which the company can acquire that particular product. Either it can manufacture that product itself, like in-house manufacturing can be done, or the manufacturing can be outsourced to some other person, or they can directly purchase this product from the market. So next is evaluating that investment proposal, that how that particular opportunity can be actually acquired by the company, through which means. So the second step is evaluating investment proposal. Third step or process is choosing a profitable investment. Now, once the investment opportunities are identified, second, all the proposals are evaluated by the organization. Next, third thing is the company has to decide on the most profitable investment and then select it. Okay. So while selecting any particular project, organization should use the different techniques, okay, of capital rationing, which we will be seeing, to the projects, different projects. Okay. And based on the return that each proposal is giving, it has to select that particular proposal which is giving maximum returns. So now students, continuing with our example, in our example, the company had to decide what is more profitable to them. That is, manufacturing the new product is profitable to them, or purchasing is profitable to them, or both the products, either manufacturing a particular product and purchasing another product is profitable to them. Okay, so it has to first evaluate, then it has to find out the returns attached to each of the proposal and select that particular proposal which is giving maximum profit. Next step is capital budgeting and apportionment. Now, what happens in this after the project has been selected? Okay, see, in the third point, it is selecting a particular proposal, so or project. So once a project has been selected, the organization has to fund that project. Now the real finance comes into picture once a project has been selected. Next is capital budgeting and apportionment, which means that now the funds has to be allocated to that particular project. To fund that particular project, it needs to identify the different sources of funds and allocate it accordingly. So obviously, when you require finance to different sources, so you raise it through different sources and then allocate it. Okay. Next, performance review. So this is what happens actually in this. This is usually the last step. What happens in this is the capital budgeting. After doing capital budgeting, you have to review your investment, which is giving when you're doing prediction about some returns, you have to see whether the performance of that particular project is up to the expectation what you had set. So whether it is giving that particular return that you had expected when you had invested in that particular project. So now it is comparison, where in performance review you are going to compare between the expected performance to the actual performance. Okay, because based on your expectation, you had selected a particular investment. Actually, when performance review is where you're going to compare what you had actually expected and what is actually happening. Okay, so in our example, we had seen that the most profitability investment, okay, could be either manufacturing the product or getting the product directly from the market, then you have to see that when you're doing the performance review, you actually have to compare that by making such a decision or by investing in such a proposal, whether your standards have been met and whether the actual expenditure that is you are incurring by taking a particular proposal that you had expected is equal to the actual expenditure, and in terms of expenditure also in terms of returns, your actual and your expected should be the same as per your performance review. Is this clear?
Yes, ma'am.
So students, when you'll decide on a particular investment proposal, like I said, your products, we in this example I've taken that we have to introduce a new product into the business line. So when you are thinking about that, you're expecting, my product is going to work very good and I'm going to have so much sales. Okay, and you will derive at a sales figure. But now actually in performance review, what you're going to do is actually you're going to see, after adding this particular product into the business line and after actually selling it into the market, whether your sales are meeting, as whether your actual sales is equal to your expected sales. So performance review will basically help you to know whether the investment decisions that you have made is up to the mark or no. So is entire capital project budgeting process clear to everyone? Yes, students? Yes. Next, let us understand what is capital rationing. Okay. Capital rationing is the act of placing restrictions on the amount of new investments or projects undertaken by a company. When a company is required to operate within a limited budget with regard to capital expenditure, it is termed as capital rationing. So what is capital rationing in short, students? Where you're going to make sure that whatever finance the company is having, okay, it raises it, after raising its finance, it allocates its finance in different proposals in such a way, okay, where there is nothing going to be in excess, which means for that it has to place certain restriction. Okay, so suppose if the company is having 10 lakh rupees, okay, or maybe 10 crore rupees for which capital expenditure is to be done. So there are different proposals or different new investments available. But since the budget is only 10 crores, the company has to, undertake the investments in such a way where it has to make sure that it is going to operate within the limited budget of 10 crores only. So so for that you have to place restrictions on your investments. You cannot freely think that you can invest, the business cannot freely think that the business can invest in any opportunities, any proposals, any new investments. Why? Because it is having a restriction of 10 crores, that is only 10 crores investment is supposed to be made. So when it has certain restriction in its mind, on the basis of which it has to make the new investments or it has to undertake the new projects, it is termed as capital rationing. So now you will understand this better, that is capital rationing is the act of placing restriction on the amount. See, your students, it is on the amount, that is 10 crores in my example, of new investments or projects to be undertaken by a company. Again, I repeat this, when a company is required to operate within a limited budget, it just has a budget of, suppose, for example, 10 crores with regard to any capital expenditure. Now, capital expenditure, again, I'm repeating, it can be acquisition, modernization, expansion of the business. Okay, it can be replacing a long-term asset, purchasing a new long-term asset. These all are capital expenditures. Capital expenditures is where the flow, the benefits are going to be are going to be received by the company over a period of 1 year. So all that are capital expenditures. So when you have to operate within a limited budget, it is termed as capital rationing. Is this clear, students? So by this, what we understand, what are the
Ma'am,
advantages of capital? Yes,
ma'am, who limits the budget? By whom it is decided capitalization?
the budget for every business will be different, students. It will be decided by the finance department of the company. There will be a particular person that will be appointed by the company who is just going to look after the finance budgets. And usually every company has a budgeting team, and that particular team is headed by a CEO, no, not CEO. That particular team is headed by a department head, and he is going to decide based on various things. See, when you have to consider your budget, you have to consider the various first expenditures. You have to consider the various savings that the company is having, the various expenditures that it is going to incur in the future. Considering all, you prepare a budget. I'll just give you a very simple example. You will understand it. Suppose if to run a particular house for 1 month, okay, you have a particular budget, correct? So suppose if it's in 10,000, you have to run your house. How is this 10,000 decided? It is based on the salary of your parents. Okay, it is based on your expenditures that you're going to incur. Okay, it is based on your savings that you're going to remove little from that amount. Suppose if your parents are earning 15,000, so some portion of that goes to the savings, some portion goes to unnecessary expenditures, some goes to uncertain expenditures, and the remaining amount is your budget within which you have to run the house. So this particular budget obviously will be decided by your parents. Similarly, this is just a very small example I've given, that how a budget, what is the amount of that budget, how it is derived. So similarly, in a company, okay, the finance department obviously knows all the financial expenditures and savings, investments, everything. It has a knowledge of everything, and it knows that with this amount it has to run over a period of time. So there is a budgeting team in every company, has a budgeting team, students. So this budgeting team basically works on seeing what is the amount of expenditure, what is the budget for a particular month, and accordingly it will work. Suppose if the expenditure is crossing the budget, then it will try reducing certain expenditures. Basically, sometimes what happens is it removes certain employees because if the cost is more. Then wherever the unnecessary costs is happening in certain areas, it will try to do cost cutting in those areas. So this is the way how budget has been decided by the budgeting team. And every company will have different budget because every company goes through different scenarios, different conditions, different, it works in different operations it has. So it is not that if this company has a budget of 10 crores, the other company also will have a budget of 10 crores. So every company has a different budget. Every company has a different, because they are working in different environment and different operations, carrying on different operations. So is this clear, students? Yes.
Ma'am.
Okay. So
Yes, ma'am.
one big advantage of capital rationing is there will be no wastage. Why? Because once capital rationing is deciding a budget, and within that budget you have to make your capital expenditure. Now why there will be no wastage in capital rationing? Because see, the company will not keep on investing in each and every new project that is available for investment. It knows it has only so much amount, so it knows that in that much amount it has to select the most appropriate investment plan. Suppose if there is no budget given to the company, so what the company will do, each proposal whichever is coming in front of it, it will try investing in that. So there will be wastage of finance. But in capital rationing, there is no wastage of finances. Plus there will be less number of projects or less number of proposals which the company is having. And when the company is having less proposals with it, it will be easy for the company to manage that project, or it will help in better management of those projects. So these are certain advantages which you can derive out of capital rationing. Is it clear, students? Yes?
Yes, ma'am.
Suppose as a birthday gift, your parents give you 1,000 rupees that you go purchase anything. Now, when you go to a shop to buy any, suppose you want to buy any attire for yourself. So you will see to buy only within a limit of 1,000. Why? Because your budget is 1,000. Will you buy something which you like for 5,000 rupees? No, because what amount you have with you is only 1,000. So you'll make sure that you purchase anything either below 5,000, either below 1,000 or up to 1,000. You will not see anything which is beyond 1,000 since your budget is only 1,000 rupees. So this is nothing but capital rationing when you take a bigger picture in terms of business firms. By this small example, did you actually understand what is capital rationing, students? Yes?
Yes, ma'am.
Okay. Now let us see risk analysis in capital budgeting. So let us understand how do you actually analyze the risk in capital budgeting. So there are different techniques by which you can analyze the risk in capital budgeting. So students, every proposal, every investment, every project is having some risk attached to it. Okay. Now, how are you going to analyze those risks? So there are certain techniques with which you can analyze the risk. See students, again I'm repeating, this is only theory. Okay, sums what you have we will be seeing in the succeeding lectures, but whatever I'm covering today is only theory for you for now also, and for your as per video syllabus also. So there are different methods of analyzing the risk in capital budgeting. So there are certain statistical techniques, there are certain conventional techniques, and there are certain other techniques. So first technique is probability and expected values. So students, can you all tell me probability technique what we are going to use, whether it is a statistical technique or conventional technique? Since you all have already finished your first semester.
Statistical.
Correct. So probability,
Statistical.
very good. Probability technique is going to help you in finding out the risk, in finding out the risk in a particular project. So probability is nothing but as you all already know, probability is nothing but a measure of a chance that a particular event will occur or whether it will not occur. So when an event is certain to occur, the probability will be 1, and when there is no chance of happening of an event, the probability will be 0. So using this particular probability technique, the uh, the budgeting manager, he can analyze the risk associated with a particular project. What is the probability of a project benefiting in a series of year, or what is the probability that it won't benefit? So using these techniques, see, I can show you some, okay, for all these 8 techniques, but the thing is you do not have problems in respect of risk analysis and capital budgeting. Simple, you just have, they will ask you is what are the different methods, and yes, just you can write two or three points based on how is this method actually going to work. So probability is nothing but it is a measure of what, a chance whether an event will occur or not occur. Okay, next is expected values. So expected values is usually a sum of the cash flows. Like when you're investing in a project, okay, you're investing that you're going to in such a way that you know that that project is going to give you a series of cash flow in the future. So expected values, based on that you are going to analyze the risk attached in the capital budgeting. Next is standard deviation method. Now, can anyone tell me whether it is statistical technique or conventional technique?
Statistical.
Statistical technique.
Now, what is standard deviation is? It is the coefficient of variation. So what variation? So what happens in standard deviation? It is again a measure of calculating the risk associated with the estimated cash flows. So obviously, when you're investing in some particular project, you will estimate that I told you expected. You will expect that this particular project will give you a series of cash flow. Okay, but standard deviation technique will help you to analyze what is the risk associated with those estimated cash flows, okay, from an investment. So this is standard deviation technique, and then formulas and all, you already know it, you'll have already seen in your first semester. But since you do not have problems in it, we will not go in detail seeing the formulas and how to solve the problems. Next is optimist and pessimist estimates. So optimist and pessimist is how positive and how negative are the persons or the estimates in respect of a particular proposals. So suppose if you have selected a proposal, how many people are positive that the proposal will work, and how many people are negative about it and are not sure that it is going to work. So based on these decisions and based on these estimates, you can analyze the risk associated to the capital budgeting. So capital budgeting is simply making an investment decisions. Next is risk adjusted discount rate. Okay, so that is also called as RADR. Okay, so it is based on a simple concept, students, that the investors, whoever is investing, will demand higher returns from the riskier projects. You have always seen that the more riskier the project is, okay, the more higher returns it carries. So when you, in short, just another example I'll give you, equity shares are highly riskier because they do not have a fixed rate of dividend, and they are always getting the money at the end after making payment to the debenture holders and preference shareholders. But why the investors invest in the equity shares? For the simple reason that higher the risk, higher is the return. Okay, so basically risk adjusted discount rate works on that principle. So the required rate of return on any investment, okay, should consider now. Obviously when you're investing in some particular project, you have some expected rate, okay, of return that that investment is going to fetch you. So that you can analyze that risk in that particular investment by using risk adjusted discount rate. Again, you have a formula for this, but which we won't be covering. Like you will consider the risk free rate, you will consider the risk premium, okay, you will consider the beta coefficient. Next is certainty equivalent methods. So under this, again, you are going to consider again, you are going to consider what is the risk associated in respect of the investment decisions that you're going to take. So this usually involves students expressing the riskier future cash flows in terms of certain cash flows which would be considered by the decision maker. Okay, like the risk, suppose the more riskier projects would be given at a higher level, because certainty equivalent methods means you're going to place your projects in such a way where the most riskier is going to be given the higher ranking where you're going to invest, and the less riskier is going to give the lower ranking. Your next is simulation method. This is again a method which is going to help you in analyzing the risk in capital budgeting. Next is decision tree approach. That is, you know how to do this. This is, basically whether you have to invest in a proposal or no. If yes, what are the risks attached? Okay, then different risk, whatever is attached, whether that risk can be managed, ignored, or transferred. Then you're going to draw a decision tree, and based on that, you're going to decide based on the risk whether you have to invest in a particular project or not. Next is sensitivity analysis. This is another technique where you're going to see how sensitive is the investment proposal. Okay, so what happens in this particular technique is, it is to see whether any impact of changes, any change that is happening around, how sensitively it is going to impact a particular project. So in sensitivity analysis, you're just going to analyze whether a particular proposal is too sensitive or not. When I say too sensitive is, suppose if any external factors, if there is any change in external factors of the organization or internal factors of the organization, whether it is going to impact the particular proposal or no. So obviously, if it is very sensitive, you will obviously, suppose if a project is very sensitive, if any changes internal external is going to affect that particular proposal investment decisions, obviously you will not go in for that particular proposal. So since in sensitive analysis you will know what is the impact of a particular change in a project. So if the risk attached is more, if the sensitivity is more, you will obviously reject the project. And if the since the risk attached is more, and if the sensitivity is less, you will obviously go in for the project or approve the project. So these are the different risk analysis techniques, methods, which are going to help you analyze what are the risks associated with the project, and based on the risk you will then decide upon the investments that you have to make. Is this clear, students? Yes.
Yes, ma'am. Ma'am, can you explain simulation method again?
See, simulation method is a way which is going to help you to analyze risk, okay, attached to a particular investment. So it is an action of pretending. Okay, it is a process where you are going to see whether a particular project is, you're going to test the project whether it is going to work or not going to work.
Okay.
Clear?
Yes, ma'am.
So usually it is a model in which it is usually a computer model in which you're going to see whether a project is more feasible or not. Okay, it is more profitable or not. And it is based on again your probability distribution. Simulation is again based on your probability distribution, that based on dependency of an event occurring or not. So then based on that you will find out the risk attached to that project, and then you will make your investment decisions accordingly. Yes. Is it clear, or do I need to explain?
Yes, ma'am.
Okay. Next is you have different capital budgeting techniques. Now, what are capital budgeting techniques? Now, these techniques are going to help you in to make your best investment decisions. So every organization wants to select the best investment plan. Okay, for that these techniques are used. So in short, these techniques are going to help an organization to select the most appropriate investment opportunity, okay, based on the comparison of inflows and outflows. So all these techniques are going to work on your inflows and outflows. When I say inflows, means the profit coming into the business, that is the income coming into the business. And when I say cash outflow, it is nothing but your expenditure. So capital budgeting techniques again is nothing but it is going to help an organization to select a particular investments based on what is the cash inflow, what is the cash outflow. So there are two techniques, that is the traditional method, which is also called as non-discounting cash flow technique, and the second one is modern method, which is also called as discounted cash flow technique method. So let us see, under traditional method, you have the payback period and you have the accounting rate of return. And in case of modern method, you have net present value, internal rate of return, modified internal rate of return, and profitability index. So students, all these, whatever are there, these are the techniques which are going to help you, which is going to help a business firm in order to select a particular investments based on inflows and outflows. Okay, now suppose in all these techniques, if your cash inflow is more than your cash outflow, simply you're going to approve the project. If it is less, simply you're going to reject the project. Now, each individually students, the payback period. What is payback period? How do you evaluate the investment decision using a payback period? The problems on payback period. So individually for all these techniques, we will be dealing from the succeeding lectures. And this complete slide, what you can see, is nothing but it is going to be theory as well as problems. So from our next lecture, we are going to first see what is payback period, how to calculate, how to use this technique. And the third thing is, with the help of this technique, how are we going to accept or reject a proposal? We are going to see problems on this. So from our next module, next lecture onwards, we are going to see each of this technique, which is not only theory, but problems you will have on all of these techniques. So we will be dealing it, since because anyways when I solve the problems I need to explain this particular technique, so we will be covering this particular theory portion as well when I start explaining the particular method or technique in my next lecture. Is this clear, students?
Yes,
because
ma'am.
because now if even if I explain, you all will not be able to relate, because theory followed by practical, you all will be able to relate it. Okay. So thank you so much, students. We are done for this session for today. Thank you.